So today we are going to discuss about the weighted average cost of capital, WACC. So the weighted average cost of capital is used to determine the discount rate or the expected rate of return, which is going to be used in our discounted cash flow model for arriving to the valuation of the company. So in my last video, wherein I had discussed about the discounted cash flow model, wherein we had seen how to arrive to the fair value of the company by utilizing all the forecasted cash flows and then discounting them to the present value. And to discount them to the present value, we use something called as a discount rate. And the discount rate is specific to every company. So we use the WACC model to determine the discount rate for every company based on various factors. So let us get to onto our screen and we will see how to calculate the WACC. Let me share the screen. So this was the Excel sheet which we have built over a series of sessions wherein we have seen how to calculate the ratios based on the profit and loss statement. We had seen how to calculate the ratios based on the balance sheet and then eventually the cash flow statement. And further on, we went ahead and we have used the Buffett methodology and we have also used the discounted cash flow model to arrive to the fair price of the company which we want to purchase the company. So now in that discounted cash flow model, we have used a concept called as the weighted average cost of capital. So today we're going to discuss basically how to calculate that discount rate or the WACC of the company. So as you see here, this is the formula for WACC. WDRD1 minus T plus WERE. So the formula, though it might look complicated, but it is a very simple formula. It's very easy to understand. To understand this, the first part of the formula, which is WDRD, this part of the formula relies on the debt of the company. It signifies the weighted average debt of the company and then multiplies that weighted average debt with the cost of debt for the company. And then the second part of the formula, which is for the equity portion. So if the debt is like say 40%, then the equity obviously is 60%. So we take both the debt percentage as well as the equity percentage of the company and then multiply them respectively with the cost of capital for the debt and the cost of capital for the equity. And of course, we need to take into consideration the tax rate in case of the debt of the company. So that is where the T comes into consideration. So now as we see here in the table, we have seen here all the parameters which I've already explained. The first parameter is the WD, weight of debt. Here we take the total liabilities of the company and divide it by the total assets of the company. Then we have the total cost of debt. How do we determine the cost of debt? We see how much interest the company is paying on the debt. We take the interest and we divide it by the total liabilities. Then we have the tax rate. So the tax rate we come by taking the income tax of the company, how much tax the company is paying, and then we divide it by the pre-tax income of the company. Then finally we have the weight of the equity. So here we take the shareholders equity from the balance sheet and then we divide it by the total assets of the company by looking into the balance sheet. And then finally we have the RE, which is the cost of equity. So for calculating RE, we use something called as the capital asset pricing model. So here in the capital asset pricing model, we use a formula wherein we identify the risk-free rate of return by looking what is the 10-year government bond yield. And then we add it to the beta of the company. Beta indicates how volatile the company is. I will take a separate video to explain exactly what beta actually represents. But for understanding for this particular session, consider that beta is how volatile the company is with respect to the general market. So the higher the beta, the more volatile the company is with respect to general market. If it is less, then it is less volatile with respect to the general market. And then finally, we take the market returns, that is the Nifty average return, and then minus it with the risk-free rate. So let us go into see the illustration, how we take the values and then finally arrive to the real value. So the total liabilities, we take it from our balance sheet, as we see here, the total liabilities I have taken for a period of 5 years. This I directly look up into the balance sheet. If you see here, balance sheet F8 plus balance sheet F14. So balance sheet F8 is the non-current liabilities. We add up with the current liabilities. So the total liabilities is equal to both the portions of the liabilities of the company. Once we get our F8 and F14, which is our liabilities, we go back into our discounted cash flow sheet, and we calculate the liabilities for all the years, and then we see what are the total assets of the company. Assets of the company, which we have already seen, that is in F20, which we have already derived it from our annual reports. F20 is here. This is the total assets, which is inclusive of both the liabilities plus the shareholder equity. That's the other way of arriving to the total assets. So then once we take the total assets, we take the percentage value, we divide the total liabilities with that of the total assets. As we see here, we take the liabilities and divide it by the total asset to get the percentage. Once we get the percentage, we take the average value for all the years, divided by 5, and this is the average value which we get. Once we have this, then we calculate the weight of equity. So to calculate weight of equity, we take the shareholders' equity and divide it by the total assets. Total assets we have already calculated in the previous table, that is in WD. So we take that value in total assets and we look into the shareholders' equity, which is in F6 row of balance sheet. So we go to balance sheet. F6 is the shareholders' net worth. So this is the row. So once we take these values, we then again take the percentages. We divide the total shareholders' equity with the total assets to tell us how much is the equity portion of the total balance sheet. So once we take this value, we take the average of all the 5 years. So we got this, we got WD, we got WE. Then we look into RD. RD is the cost of the debt. That means how much interest the company is paying on the debt. So we take out the interest from the P&L, profit and loss. So I looked into the profit and loss statement, P&L B9, finance cost. This is the values of the interest which the company is paying on the debt. So we take these values and then we take the total non-current liabilities. So that is it is paying interest on all the non-current liabilities. That is the long-term liabilities of the company. So we take these values from balance sheet and then divide it. Both of these we divide to get a percentage. So we get a percentage of 4.5 for Colgate-Palmolive. So then subsequently we calculate the tax percentage. So we look into how much tax the company is paying and divide it by the total profit before tax by looking into the balance sheet of the company. So this you already know. Anyway, just to recollect, F18 is where the tax is stored. F18, which is a provision for tax. And then we have a next value, that is our profit before tax. We have both these values. Both values we take into this table and we calculate the total percentage of tax. So by this we get the average percentage of tax which we have represented here. Now that we know all the major portions of the formula, we get into our last portion of the formula, which is our RE. That is a return or the cost of equity. So for calculating the cost of equity, we find out what is the 10-year government bond yield. To get this value, we look into this governmentbond.com India. This is the link where you can find out the 10-year government bond yield. It is about 7.3. It is noted down here. And then you have the beta of the stock. For beta of the stock, you can go to moneycontrol.com. There is a entry there. There's a parameter called beta. You can take that value, 0.44 in case of Colgate-Palmolive. Advisable, you can go into Yahoo Finance. There you get a much 1-year average of beta. So you can take that value of beta. And then next we get into the market returns. This is the market return since 24 years. So 1998 value and then 2022 value. it was like about 13.7%, roughly 14%. And then finally we calculate the total cost of equity. So to calculate cost of equity, we take the risk-free rate, that is 7.36. You see here 7.36 plus we take the beta, which is at N56, and then we subtract the market returns with that of the risk-free rate to get the total cost of equity. So the cost of equity is 10.14%. So now that we got all these values, we put back into a WACC model. So we have this WACC model here. Looks like I overrid it with the generic percentage. Let me calculate it anyway here. So we take WD, we multiply WD with the RD, that is our cost of debt, and then we subtract it with the tax on debt. And then we add it to the weight of equity and then multiply it with the cost of equity. Coming as ref. Let's see, what do we do wrong? Oh, wasn't I multiplying somewhere? Oh, here the problem is I had to multiply it. So here we go. Apologies for the delay in identifying the issue. But here we get the value, that is 7.07. So this is how the WACC is calculated. So this percentage we can use into our discounted cash flow model to arrive to our fair value of the company. So this entire discounted cash flow model is already demonstrated in the previous videos. You can have a look at it to arrive to the fair value of the company. Just to let you know, my most preferred model is the Buffett valuation, as well as there is other two models which I will be showcasing shortly. So please subscribe so that you can gain from all the sessions with respect to the valuations of the company. Of course, after we cover valuation, that's not the end. We are going to look into the secret sauce of investing very soon. So please subscribe so do not miss the main aspect of the entire course of sessions, wherein we understood what's the share, and then finally we went into accounting, and then we looked into valuation ratios. It's a step-by-step process, and finally we go into a final stage later on after some few more weeks, wherein we'll see how we can do investing very simple.